Welcome to the world of Mark's Money Mind, coming to you from Longmont, Colorado. I am your host, Mark Troutman. This educational personal finance show combines money lessons, timely topics, personal stories, and community wisdom to help listeners and viewers master their finances to enjoy a stress-free life of financial freedom. Well, what have I been up to these past 2 weeks? I just got back from New Jersey, where we had a beautiful celebration of life for my niece Emily, who I dedicated the last episode to. And it was really a beautiful, beautiful event and well-deserved for her. When I got back, this is the time of the year that I do fourth quarter income and tax planning. Since this is the Mark's Money Mind show, I just thought I would talk about what has been on my mind for the past week or so since I got back and what I do around this time of the year. We've talked about the one-page financial plan before in episodes 48 and 39. And that's kind of what I do at this time of the year. I've just received my third quarter financial documents from banks and investment accounts and so forth. So I have a pretty good grasp on everything that occurred, obviously, in the first 9 months of the year and can kind of start laying out what the rest of the year is going to look like. So what I do is I pull out my one-page financial plan and I start checking off all the progress I've made and look for anything that I still need to accomplish. And for me, it is quite simple. I don't have any earned income, so I don't have to really project out what my paychecks are going to look like going forward. But I do have some other things, and this year is quite interesting for me. I will actually be receiving Social Security benefits as a survivor in the last 2 months of the year. I turned 60 this month in October, and why don't we talk a little bit about what that means for a survivor? So a lot of people would say, 60? How are you getting Social Security at age 60? Well, if you are the spouse of someone who has passed away, you can receive survivor benefits. And the way that works is if you are age 60 or older, you can claim on their record. And I believe it's 50 or older if you're disabled, but that's not my case, so it's 60 for me. Now, the benefit is reduced if you claim early, and early would be anytime prior to your own full retirement age, which for me is age 67. So some people might say, well, why are you claiming at age 60 then? You're going to receive a much reduced benefit. Well, here's the thing. So my own benefit is actually larger than my wife's would have been if she was claiming, or for me as a survivor. And even though I would claim a survivor benefit on her record, it does not affect my own claiming strategy. The two are in essence not connected. So while I will be claiming early on her record at age 60, I will let my own benefit grow past full retirement age all the way up to, or really past my claiming age. Earliest claiming age for me would be 62. But given that I have a survivor benefit available, it makes sense to claim on her record from age 60 to my age 70, and then switch to my own, which will have received delayed credits as a result of waiting until age 70. So claiming early, in essence, on the survivor benefit does not affect my own benefit growing to its maximum benefit at age 70. Now, what's interesting about how all this works is if you go into your own Social Security account, you don't see anything about a survivor benefit if your spouse passed away, nor do you see how much it might be. So you actually have to go to Social Security or call them and find out what your benefit might be. And I think that's something that a number of people I've spoken to are just unfamiliar with, because it's not like you can pull it up and see it on your own account when you log into Social Security. And I really think that's a disservice because I think there's a number of people out there who may be able to receive a survivor benefit and don't because they're unaware that they can claim it, or that there may be a strategy where they should claim one and then claim their own later. In the case where if you are the survivor and your own benefit is larger than your deceased spouse, it makes very much sense to claim between ages 60 and 70 on your spouse's record and then switch over to your own. Now, if your deceased spouse's benefit is larger, then that does change a little bit, but there are different programs out there where you can kind of do what if scenarios and so forth. But for me, it was pretty straightforward. But what I did have to do is I had to be proactive. It's not like Social Security sends you a letter and says, hey, by the way, you're eligible for this benefit. You have to know that you're eligible for it and be proactive and call them or go to the Social Security office. In most cases, you have to make an appointment. It was suggested that I do it a number of months in advance. So I actually did it in, I think it was August, where I made the appointment, and I did have to go in and show my marriage certificate. Also, had I remarried prior to age 60, I would not be eligible for a survivor benefit because I would be linked to that new spouse. So that is another thing. However, if you pass age 60 and get remarried, it's okay. But you do need to wait until age 60 to be remarried. It's not my intention to do so, but it's just that's the rule. So that didn't affect me, but that's something to be aware of. So anyway, that was kind of my little Social Security story. And what I found out was my birthday is in October. So my benefit will actually start in November. And I've also requested that they withhold the highest withholding amount, which is 22%. And we'll get to that in a little bit later. But I did that so that I could use that withholding tax to help satisfy other taxes I might owe as a result of other income I have that does not have withholding. And we'll talk about that in a little bit. So anyway, that was my kind of little Social Security sidebar. And that was one of the things on my one-page financial plan was to claim Social Security. It's actually right there. I'm looking at the list here in August for it to start in November. I was able to calculate it pretty accurately, and here's how I did it. Certainly, I could have called and got the exact number, but when my wife passed away, I actually had her last copy of her Social Security record, and it says right on there what your death benefit would be for any spouse. And not just the one-time death benefit, but the survivor benefit. And then I was able to use the Social Security website to determine what the inflation calculations were for each year thereafter and kind of have a rough estimate. And it was pretty accurate. And they told me what the monthly amount would be. They've also sent me follow-up letters saying when it'll start, what it will be on a net basis as a result of the withholding. I was able to link a account for it to go into, and I noticed that that link had been established because on my account, I could see that there was like a zero deposit or something like that. So I could see that they were testing it to make sure it worked. So presumably it will show up in November. So that's part of what I do at this time of the year. I'm trying to figure out what are my income streams for the year. So in my case, I have these 2 months where Social Security will start and that I haven't had before. So I have to kind of factor that into my calculations, and also what the tax withholding is for that. And I can calculate that into my estimated taxes that I will need to pay and so forth. So the other thing that someone might need to do at this time of the year, which I don't, but others might, is if you have any required minimum distributions, RMDs, from an IRA, a 401k, an inherited IRA, an inherited 401k, those are things that you need to make sure that you get done at some point if you haven't done them already. And also factor in what those will be, because if you haven't done it yet, that is income that will be happening in the fourth quarter in order to satisfy that RMD requirement. The other thing you can consider doing is if you are over age 70 and a half and charitably inclined and have not taken your required minimum distribution yet, or even if you have, you can do what's called a qualified charitable distribution, which is a QCD. And effectively what is happening in that case is you are making a charitable contribution to a 501c3 charity, and that distribution will be made from your IRA as you direct it, and it will not be taxable to you or the charity, but it will also satisfy your required minimum distribution. So if you're charitably inclined, it is beneficial to use the QCD as a way to satisfy your RMD, or at least a portion of it, and that charitable intention that you have. It is a very tax efficient way of giving to charity. So that's something to consider. If you haven't taken your RMDs yet, you want to put that on your list and make sure that's going to get taken care of by the end of the year. So the other thing that I will do at this time of the year is estimate what my earnings will be for the rest of the year. So for me, I don't have any earned income. Therefore, I don't have any paychecks to estimate. And that's the other thing. I do want to backtrack a little bit on the Social Security survivor benefit. Because I don't have any earned income, I'm not subject to what's called the earnings test. If you make over a certain amount of money and you are claiming Social Security, whether it be survivor or your own Social Security prior to your full retirement age, there's something called the earnings test. You can't make over a certain amount of money before they start clawing back your benefits. Now, you will get that trued up to you later, but I don't have any earned income, so I am not affected by the earnings test. But that is something to be aware of. If you do have earned income and you want to claim Social Security, whether it's a survivor or your own benefit, it would potentially be subject to the earnings test. And it's a fairly low figure. I don't have it right in front of me, but you could probably have a part-time job of some type. But if you're a full-time employee, you're likely going to be over that earnings test limit. And then it's prorated as your earnings increase. And ultimately, the earnings test kind of wipes out your Social Security benefit. So I won't go into the detail of here because that could be a whole nother episode. But just be aware that it could be subject to the earnings test. Doesn't apply to me. The other thing that I do at this time of the year is I look at my year-to-date interest and dividend income. All of my taxable brokerage accounts are invested in things like money markets and treasuries. It's not a significant portion of my overall portfolio, so I use it kind of for liquidity purposes. And so I have a really good handle on what that interest and dividend income is. This would also include interest on online savings accounts, which I have a few of. So I start to look at it from the standpoint of I know what the monthly and quarterly interest and dividend income amounts are, and I can pretty accurately project out what they will be for the rest of the year. Capital gains could also be something that you might have, especially in the fourth quarter. If you have stock funds, for example, especially those that are actively managed, they tend to sometimes hand out pretty substantial capital gains, especially ones that may be unexpected. So usually in December, they will start handing out estimates as to what they will be. But if you're in index funds, usually you're not going to have any capital gains because they're very efficient from that standpoint. I don't have any, so that doesn't affect me. As I mentioned, I will have some Social Security income. I know what those dollar amounts are. I do not have any pension income, but if you have pension income, you would need to tally up what that will be for the rest of the year, or potentially any annuity income or something of that effect. I don't have that either. So I have a pretty good handle on what my income will be through the rest of the year. So here's where I start to do a little bit of math. Let me backtrack a little bit. At the beginning of the year, I decided to target my income for the top of the 12% tax bracket. I'm single, and so for the single tax bracket, it's around somewhere in the neighborhood of, I think it's $60,000, including the standard deduction. It's in that ballpark. And the reason I did that was I always like to fill up the 0%, which is your standard deduction or itemized if you itemize, the 10% bracket and the 12% bracket. Because to me, I feel that those are very attractive tax rates that should be taken advantage of. My personal opinion, do what you want, but that's how I feel. So to me, it's a no-brainer to target the top of the 12% tax bracket. Now, as a result of that, I am on the ACA for health insurance. And at the top of the 12% bracket in 2025, as a single, I would get a small subsidy towards those insurance premiums. And when I applied for my health insurance, and very soon we're getting to open enrollment for 2026. So last year, at the end of the year, I applied for my health insurance and they asked what my estimated income would be. And I told them it would be in the neighborhood of $60,000. And they said, okay, well, then we will give you advanced premium tax credits, which basically means that instead of paying the full amount for my insurance premium, I would pay a lesser amount. And as long as my income was as I expected, I would receive those tax credits in advance, in essence. And the way they true it up is when you do your tax return, they look at what your actual income is relative to what you said your income would be. And if it's lower, you may even get some more credits back. But if it's higher, you may have to pay back those advanced premium tax credits. And so I'm going through the year and I'm saying to myself, okay, I'm anticipating being in the 12% tax bracket. But then at this time of the year is when I start to think about, all right, that's a no-brainer for me. Again, personal opinion for myself. I like to fill up the 12% tax bracket, but should I consider going into any brackets above that? The next two being 22% and 24%. Now, by doing that, I will lose potentially some or all of those advanced premium tax credits for ACA. Now, for me, I view that as kind of just a additional tax, if you will. And I figured out, well, if I went to the top of the 22, how much would I give up? And what does that mean the 22 really becomes? And it's in my case, somewhere in the 23, 24%. So basically an additional 2 percentage points about. And the same if I go to the 24, because it will already have been eliminated once I got into the 22 or well through the 22. It's still just a few percentage points above the 24 because I'm not paying any extra because I've already given up the credit once I went through the 22, for instance. So every year I let myself at the end of the year decide, should I go to a higher tax bracket? Last year I did decide to go, well, I didn't actually decide. I was forced to get into the 24 because I sold my house and had a capital gain. So it's a whole nother story. But this year I had a decision. Did I want to just stop at the 12% or go right up to the 22? And in my opinion, if you're going to do 22, you might as well do 24 because it's not much more. The next one after 24 is 32, and that's a big jump. So to me, it's kind of like either I go to the top of the 12 or I go to the top of the 24. So I decided I will go to the top of the 24 this year. Now, why would anyone pay their taxes before they need to? Why would I decide to go to a higher tax bracket? And also, what do you mean decide? Like, how do you decide? What are you doing that makes you decide? And so for me, it's really, I look at my IRAs that have yet to be taxed. So my traditional IRA, for example, my inherited IRA, and we'll get to inherited IRAs in a moment. How much is in there? If I don't do any conversions, what will it potentially grow to in the future? What will those required minimum distributions be when I'm forced to take them? And in my case, it's age 75. What will that look like if I do nothing? And in my case, I actually hired a planner to help me figure this out, but I've also do it on my own as well. And if I do nothing and just go to the top of the 12 every year, I will have very high required minimum distributions at age 75. So it makes sense to utilize some of those next tax brackets, such as 22 and 24, to reduce those future RMDs. Again, you're never certain as to what those will be because you don't know what returns will be. You don't know what tax rates will be. It's really a judgment call, and it's a year-by-year judgment call. It's not like, oh, well, if I go to the top of the 24, I have to do that every year. No, it's a year-by-year decision. So for me, I've decided I will go to the top of the 24. And so now you might be asking, what do you mean go to the top of the 24? How does that work? Well, if I do a Roth IRA conversion, which basically means I move money from my traditional IRA and do what's called a conversion and move that money from the traditional IRA to my Roth IRA, it is a taxable event. There are two ways to pay the taxes. One way is to pay the taxes from outside money. So that would be like a cash account that you have, checking, savings, regular brokerage account, what have you. Or if you're over age 59 and a half, you could do a conversion and ask the custodian to withhold a percentage of that conversion to pay the taxes. So that's actually what I do. I had and I'll explain why I say had, a inherited IRA that I received from my spouse. And for years in the past, I would make a distribution. Can't do a conversion from an inherited IRA, but I can do a distribution from an inherited IRA, and I can ask the custodian to withhold a portion of it. And I was actually doing enough, so I withheld, in the custodian that I have allows me to withhold up to 99% of that distribution. So that's what I was doing. I was basically making a distribution large enough to pay the taxes on all of my income. Now, of course, when you make that distribution, it adds to your income. So you need to make sure you add that in as well as part of your income to appropriately calculate your taxes. But that's what I was doing. Now, this year, as I mentioned, I will be turning 60 this month. I've obviously passed age 59 and a half. So since my IRA that I inherited was from my spouse, you can include it as if it were your own IRA. You can combine it. That only works for spousal inherited IRAs. Since my IRA was inherited from my spouse, after I turned age 59 and a half, I combined it with my own. The reason you would want to keep an inherited IRA from a spouse separate from your own, even though you could combine it at any time, it makes a lot of sense to keep it separate until you turn age 59 and a half. The reason being that if you take a distribution from an inherited IRA, there is no 10% early withdrawal penalty. So if you're under age 59 and a half and have a spouse's inherited IRA, keep it separate so that you can make distributions without the penalty. You still have to pay the taxes, but you can make distributions. You can do what I've been doing, which is making distributions and withholding whatever percentage you want for tax purposes. Now, if it's an inherited IRA that you inherited from a non-spouse, you cannot combine it with your own. And also, you'll be required to make required minimum distributions from an inherited IRA that was not from a spouse. If it's from a spouse, you do not have to make required minimum distributions until your spouse would have turned the age required to take required minimum distributions, which for many today is now 75. If your spouse was significantly older than you, you may want to consider combining it with your own prior to when they would have turned their required minimum distribution age. But in many cases, they're similar in age or potentially younger, and then you will want to keep it separate. And then once you turn 59 and a half, you can combine them. Anyway, long story about that, but it is something definitely to think about because in my case, the custodian immediately went to combine it with my own, and I actually had to call them and say, whoa, slow down. Don't do that. Keep it separate. They were inclined to just go ahead and combine it. So make sure that when you set up the inherited IRA and it's from a spouse, that they do not combine it if you're under age 59 and a half. So anyway, what I was saying before is that how do you decide what your income is going to be? What I do is I use a calculator. It's a tax calculator. It's a free online calculator. It's by DinkyTown, which is a funny name, but it's a great tax calculator, and I'll put the link in the show notes. And what you can do is you can input all of your estimated income, and it has been updated for the new OBBBA Act that was put into law on July 4th. So the new higher standard deduction amount is in there. The over age 65 special standard deduction amounts, I won't get into all those, but there's extra amounts that increase your standard deduction if you're over age 65. Those are all in there. My understanding is that I know that standard deduction amounts are all in there, but I think also that is in there as well. So it should all be updated. So in my case, I have no earned income, so that's nothing there, but I put in my interest income and dividend income, and I estimate what it'll be through the rest of the year. So I put in there, and I also padded a little bit just to be safe. I put in my Social Security income. Social Security income is only taxed up to 85% of it is taxable, so it takes that into account. Any pension income, if you have it, any distributions you've already taken from IRAs. So every year at the beginning of the year, like I said, I was targeting my income to be around $60,000. I had no real earned income. I had some interest income, but it certainly wasn't going to be $60,000. So I did a Roth IRA conversion toward the beginning of the year. Now, why would I do that? Because when that money goes over from the traditional to the Roth, it is a taxable event, and I do owe taxes on it. But the interest that it earns in the Roth is tax-free. So I'd rather have it over in the Roth sooner rather than later, but I don't do it all at the beginning of the year because maybe there'll be some earned income. Maybe my interest and dividends will be higher than I expect. Maybe I want to target a lower tax bracket than I was originally planning. I don't know. But I like to wait until the fourth quarter to do my kind of true up Roth conversion, which is where we are today. So then what I can do is put those figures in DinkyTown as I know them, and then I can start playing with, well, what if I did more Roth conversions? How much more could I do and still remain within my targeted tax bracket? How much would it be if I just wanted to top off the 12%? How much would it be if I went to 22? How much would it be if I went to 24? And then also, there's another challenge, and that is that I received the ACA subsidies, the advanced premium tax credits. Those will need to be paid back, and DinkyTown even has a line item for how much do you need to repay there, and it will calculate, your tax liability, including that as well. And then also, what I need to figure out is I made some estimated tax payments throughout the year, but they were fairly nominal. They were targeting my income to be at the top of the 12%. If I go to the top of the 22 or 24, those estimated tax payments are not going to be enough. Now, the way the IRS wants to receive its tax payments is equally throughout the year through estimated taxes. However, if you use withholding or pay through withholding, whether it's a paycheck or withholding from distributions from an IRA, for example, it assumes that those are received throughout the year, even if they were all done in December, for example. So I could pay a larger estimated tax payment in the fourth quarter, which is actually due on January 15th. And there's a way to fill out Form 2210 to explain that your income was not even throughout the year because the IRS assumes your income is earned evenly throughout the year. But let's say you do a big conversion at the end of the year, then your income obviously wasn't even. And you can use Form 2210 to say, hey, this is how my income actually came in throughout the year. And it's quite involved, but it's doable, and then make the appropriate quarterly estimated taxes. So in my case, if I did a big, let's say, conversion in the fourth quarter, which would require me to make more in estimated tax payments, I could satisfy that with a January 15th, 2026 estimated payment, and all would be fine, and I wouldn't necessarily receive a big penalty. But I've decided now to just do it all through withholding and make my life a little easier. That doesn't help on the state side, so I'll still need to fill out Form 2210 for my state taxes, but that shouldn't be a big deal. The state tax rate is much lower in Colorado than it is on the federal side. And also, some retirement income is exempt in Colorado, which is great. I know this sounds very complicated, but this is what I do at this time of the year. And I do it now instead of in December because you've got the holidays. You don't want to be pushed up against a short window at the end of the year. I really like to do all of this in October because, like I said, I've received the investment statements through the third quarter. I have a pretty good handle on what interest payments are going to be through the rest of the year, dividend payments, things like that. So it's pretty easy to calculate. Now, does that mean I need to go ahead and do the withholding today? No, I can wait until December to do the withholding. Do I want to go ahead and do a little bit more conversion if I've decided to step up to the next tax bracket? Yeah, and that's what I've done in October. I will still kind of fine tune it in December just to make sure, but that's where I stand right now. So this is what I do in the early part of October. The other thing that I'd like to do is what I call funding my paycheck for next year, what my planning is for my next year's paycheck. And before I get to that, I do want to talk a little bit about the planning window that I'm starting to realize a little bit better now that I'm turning 60 very soon, is that there is a kind of Roth conversion planning window prior to your required minimum distribution age. For me, that's 75. However, there are really two parts to it. The first part is before IRMA is calculated. What is IRMA? IRMA is the income-related monthly adjustment amount for Medicare insurance premiums. Basically, what that means is that if you have a certain amount of income over and above a set amount, you will have to pay extra for your Medicare premiums. And it is a scale. There's multiple tiers to it. And if you go $1 over that tier, you're bumped into the next IRMA category. So you need to be very careful about not tripping those. Now, you would think it would go into place when you turn age 65 because that's when you start Medicare. The reality is it comes into play in the year you turn 63. And the reason is because they look back 2 years. They look at your income from 2 years prior, because at age 65, that's the last year that you have already filed your taxes. So they need to look back 2 years. There are ways to get an exemption from it if you had certain life changes. But for me, I'm not planning on those life changes, so I need to be careful. I don't need to worry about IRMA until the year I turn 63. And since I turned 63 in October, it would only affect me for 2 months in the year I turned 65, because I would only be on Medicare for 2 months in the year I turned 65. So it may not be as big of a deal, so I could probably go ahead and do some big conversions even in the year I turned 63. But I need to be aware of IRMA in the year I turn 63. For now, that doesn't apply, but that also means that since it doesn't apply yet, going up to the top of the 24% is another benefit before the year I turn 63, whereas if I go up to the top of the 24% in the year I turn 63 or later, I would be subject to a few tiers up in those IRMA brackets. So I need to kind of be aware of that. It is at the end of the world? No, but it does kind of add to your tax rate in essence, just like not receiving ACA subsidies does. Same kind of deal, except for in IRMA's case, it's about on that marginal dollar from one bracket to the next, it could be as much as a 4% bump. So your 24% bracket may be 28%. So something to math out. Don't have to worry about it this year, but it does give more reason for me to consider going up to higher brackets before the year I turn 63. So let's jump to the paycheck. Here's what I do. I like to know where my next full year's worth of paychecks are coming from. I want it in an account that's not subject to market volatility, that's identifiable, and I view it as a liquidity account. And I'll just kind of give you a little insight into how I do this. Is this the only way to do it? Absolutely not. But this is the way I do it because I need to have structure when it comes to my allowable spending, I guess you would say. So what I like to have is a fully funded liquidity account. And the way I do that is I have a money market account in a taxable brokerage account that has my entire next year's spending requirement. Now, next year I can adjust it a little bit for the fact that I'll be receiving Social Security, so it doesn't need to be as much as maybe I received this year if I want to receive the same amount of money. But the full year's amount is in a money market account in a brokerage account. That could be, let's say you could put that all in a checking account. Hopefully it pays interest, your checking account, because I wouldn't want to have a whole year's worth of income sitting in an account not earning interest, and that's the reason I have it in a money market account and brokerage account. But I also wouldn't want, me personally, to have it all in one account where I spend it down throughout the year. I kind of have the need for a monthly distribution. So the way I accomplish that is, I think I've mentioned before, I use a cash management account. It is an interest-bearing checking account, I guess you would say. It is also at a brokerage firm. So what I do is once a month, I have money that's moved automatically from my money market in my brokerage account to my cash management account. It's just like a paycheck if I were working at a regular job. So I receive, except for it's monthly instead of twice a month, but the beginning of every month, a monthly amount comes into that account. And then that account is used to automatically pay all of my credit cards. And that sounds like, wow, you have a lot of credit cards. What's the deal? Well, I use credit cards like a debit card. I pay my balances off in full every month, and they're automatically paid. So the way it works is the credit cards I have, and I have a few of them because I do the points thing and cash back and stuff like that. I use them in various ways to maximize my points. But every month when those statements are generated, the automatic payment is set up so that each one of those cards is paid automatically in full. I don't have to worry about paying any interest on those cards because they're paid off in full, and it's paid automatically. I don't need to worry about making a payment manually and risk missing it or not paying enough. There is an easy way to set up your credit cards to be paid in full automatically from a linked account, which is what I do. And I use those cards for all of my spending. So it's kind of this perpetual automatic system. Now, I pay attention to it. I monitor it. I know what I'm spending. I keep track of the spending so that I'm not overspending. But I make sure that it certainly is within the limits of my monthly paycheck. Now, this works as long as I have money in taxable brokerage accounts, right? So what will I do once those taxable accounts are depleted, which will happen eventually because I have been doing conversions from my traditional IRA to my Roth IRA, and I have not necessarily been taking money out of the Roth IRA. I've just been spending down my taxable brokerage accounts, but eventually those taxable brokerage accounts will be depleted. This same process can work by using a money market account in a Roth IRA. So the plan there will be, and this would be the most tax efficient way to do it, while earning interest on that money market account that is in the Roth IRA. So the objective will be every year, probably at the end of the year, I'll decide how much to convert from my traditional IRA to my Roth IRA. I will likely withhold from that conversion enough for the tax liability for the entire year, and then the difference will go into the Roth IRA. And then from that Roth IRA, instead of money coming from the money market account in a taxable brokerage account, it will just come from the money market account in the Roth IRA directly to either the liquidity account in a brokerage account and then to the cash management account, or potentially just directly to the cash management account on a monthly basis. And that's probably more likely what I'll do. I'll just skip the money market brokerage step and just go from traditional IRA, convert to Roth IRA, withhold taxes for the conversion, and then monthly have a paycheck from my Roth IRA money market into my cash management account. And then the money kind of sits there in the Roth IRA, earning tax-free interest until I need it for my monthly paycheck. So that's what I'll do once the taxable brokerage account is depleted. That is what I do at this time of the year. I kind of view it as a fun little exercise. It gives me some satisfaction that I've hopefully optimized as best I can. Of course, you can't optimize perfectly, but like I said, I do it on an annual basis, try to do the best I can, and then also set myself up for the following year, knowing where my paycheck is coming from, how it's all going to work. And then really, I don't need to do much. At the beginning of the year, maybe I'll do a conversion for part of the money and then do a true up at the end of the year. But again, it's just kind of this year-end tax and income planning. And I find that October, it's kind of the best time of the year for me to do it. So hopefully this helps you out a little bit. You can see what I do. This is not advice. I'm not suggesting you do it this way, but sometimes understanding how someone else does something gives you some ideas on how part of it or all of it or any of it may work for you. I hope you found this little exercise beneficial, and I wish you a great fall. And I look forward to updating you in the future on new stuff as it comes into my mind. See ya. Thank you for listening to this week's show. Please click follow on your favorite podcast player or subscribe on YouTube to ensure you don't miss any future episodes. Also, please leave a rating and review for this show. This helps improve the ranking and enables other like-minded people find the content in their podcast players. I would also appreciate it if you would recommend this show to friends and family that might benefit from this content. See you next time on the Mark's Money Mind Show. Until then, make some, save and invest, live on the rest. Now for the all-important disclaimer. This show is for education and entertainment purposes only and should not be considered investment, tax, or legal advice. Please consult the appropriate advisor or advisors before implementing anything you hear on this show or any other show for that matter. While I fully intend for everything on this show to be true and accurate at the time of each recording, occasionally errors may occur. So please do your own due diligence on anything discussed.